Can a company, long defined by its legacy, truly reinvent itself for a future that looks nothing like its past? We're diving into the story of a tech giant that's currently undergoing one of the most profound transformations in recent memory. Today, we're taking a deep dive into Oracle Corporation. This isn't just another tech company. It's a colossal entity at a critical inflection point, placing a massive bet on the future. We've sifted through a mountain of sources, everything from intricate investment analyses and nuanced market forecasts to comprehensive financial reports, all to give you a shortcut to being truly well-informed about Oracle's bold, capital-intensive push into cloud and AI.
And our mission today is to unpack precisely how Oracle, a company many of you might still primarily associate with its foundational databases and on-premise software, is attempting to become a formidable top-tier competitor in the explosively high-growth cloud infrastructure and artificial intelligence markets. We'll explore the optimistic bull perspectives and the cautious bear arguments, dissect their intricate strategy, and highlight the critical metrics you need to watch to understand if this gamble pays off.
That sounds like a journey of epic proportions. So let's unpack this transformation and really grasp not just what Oracle is up against, but the audacious vision they're trying to achieve.
Okay, so at its heart, Oracle is navigating this truly profound shift. For decades, they were the quintessential on-premise software provider, right? Synonymous with powerful databases humming away in corporate data centers all over the globe. But now, they're aggressively pushing to become a major player in cloud infrastructure and AI. It's almost like watching a venerable cruise ship attempt to transform into a high-performance fighter jet mid-voyage.
That's a perfect analogy because the scale of this pivot is immense. What's truly fascinating here is that Oracle's entire future success hinges on leveraging that existing, deeply entrenched database leadership, the one they built their empire on, to fuel the adoption of their Oracle Cloud Infrastructure, or OCI. It's a clever, almost Trojan horse strategy, you could say. Use the very thing you're known for to propel you into a new, incredibly competitive space.
But simultaneously, they're on the defensive, working intensely to protect their massive enterprise applications business from an army of cloud-native rivals who are constantly trying to chip away at their market share. So this isn't merely a strategic pivot, it's a multi-front war for market relevance and ultimately future growth.
And what's fueling this multi-front war, this incredible urgency? You mentioned a wave reshaping the landscape.
Exactly. Imagine a colossal wave reshaping the entire tech landscape, driving every enterprise, large or small, to fundamentally reevaluate their IT strategy. That's precisely what the enterprise software market is experiencing right now, driven by the relentless forces of digital transformation, the widespread adoption of cloud computing, and of course, the explosive, unprecedented growth of AI.
So it's not just a trend, it's a super cycle.
It absolutely is.
Right.
This market isn't just growing, it's projected for truly robust, sustained expansion. We're looking at a compound annual growth rate, or CAGR, of approximately 11.7% to, say, 12.1% through 2030.
Wow.
To give you some context, the entire enterprise software market could jump from about $251 billion in 2024 to over $761 billion by 2034. That's a near tripling in just a single decade.
Incredible.
And what's driving this? Enterprises are desperately seeking automated, integrated, and data-driven solutions to enhance their operational efficiency, reduce manual processes, and simply keep pace with the accelerating demands of the digital economy.
And the real undeniable catalyst within this supercycle, it has to be AI, right?
Yeah.
Artificial intelligence and machine learning. AI isn't just a buzzword or some futuristic concept anymore. It's fundamentally reshaping the software as a service, or SaaS, model right here, right now. We're moving beyond simply selling software licenses or even basic subscriptions. We're now providing deeply integrated AI-powered services that can automate entire workflows, generate incredibly personalized insights, and even make predictive recommendations. Think about it. Instead of just a spreadsheet program that calculates, you have an AI assistant that analyzes your data, spots trends you'd miss, and tells you exactly what to do next to optimize your business. That's a paradigm shift.
It's more than a shift. It's a mandate for survival for many incumbents. This trend compels established vendors like Oracle to embed AI capabilities across their entire technology stack, from the foundational infrastructure all the way up to the applications layer, if they want to remain competitive and relevant.
Okay.
And here's the profound insight. It's also leading to new, more flexible revenue models beyond the traditional flat subscription. We're seeing a move towards usage-based and outcome-based pricing, where customers only pay for the value or resources they actually consume.
Right, aligning their success with the customer's actual value derived.
Exactly. For a company like Oracle, this is a massive change from their historical licensing model. It directly aligns their success with the real value customers extract.
So if this is the super cycle and AI is the primary catalyst, what does this all mean in terms of the sheer size of the opportunity Oracle is chasing? What kind of multi-billion-dollar markets are we talking about here? How big is the prize?
The prize is immense, and Oracle is strategically positioned to capture a share of several multi-billion-dollar markets. Let's break down the total addressable markets, or TAMs, they're targeting.
Okay.
First, there's cloud computing, which is, the grand prize. This umbrella term includes infrastructure as a service, IaaS platform as a service, and software as a service. This is a truly colossal market, estimated at $752.44 billion in 2024 alone.
Just this year.
Just this year. And it's forecast to grow at an incredible 20.4% CAGR to nearly $2.4 trillion by 2030.
Trillion. Wow.
Within this vast market, infrastructure as a service, or ISS, which is essentially raw compute power and storage, that's actually the fastest growing component, with an expected CAGR of 22.0%. That's where Oracle is making its biggest, most capital-intensive play.
Makes sense.
Next, we have database management systems, or DBMS. This is Oracle's historical stronghold, a market they literally built their empire on. The global DBMS market was valued at about $150.38 billion in 2025 and is projected to reach $292.22 billion by 2030. That's a healthy 14.21% CAGR.
Still significant growth.
Absolutely. And even with the rise of new data types and non-relational databases, relational databases, Oracle's traditional strength, still command a majority 58% market share.
Still the majority.
Still the majority. However, it's crucial to note that newer NoSQL databases designed for flexibility with unstructured data are growing faster at an 18.1% CAGR,
okay.
driven by the explosion of big data from IoT and social media. So Oracle faces both enduring strength and new challengers here.
Right, a complex picture.
And finally, the segment set for truly explosive growth, enterprise generative AI. While still nascent, this segment is estimated at $2.94 billion in 2024, but it's forecast to expand at a staggering CAGR of 38.4%.
38%? That's huge.
Huge, reaching nearly $19.8 billion by 2030. And this isn't just abstract growth, it directly fuels demand for the high-performance cloud infrastructure needed to train and run complex AI models, particularly large language models, or LLMs. This is precisely where Oracle is making its big bets, aiming to be the preferred infrastructure for AI innovators.
So beyond the sheer staggering size of these markets, what about the key technology trends that are actively shaping enterprise IT strategies? What are the big shifts driving how companies are spending their tech dollars and designing their systems?
Excellent question. 3 interconnected trends are paramount and dictate where cloud providers are focusing their investments and how enterprises are planning their digital future. First, there's artificial intelligence. AI has transitioned from a niche technology to a core enterprise priority for practically every major corporation.
It's everywhere now.
Everywhere. The proliferation of generative AI in particular is driving unprecedented demand for specialized cloud infrastructure, specifically massive GPU clusters for both model training and inference. Cloud providers are actively re-architecting their platforms for AI-specific workloads, creating an entirely new axis of competition centered on performance, cost efficiency, and access to these specialized AI compute resources.
Got it. What's next?
Second, multi-cloud and hybrid cloud strategies are rapidly becoming the de facto norm. Enterprises are actively and deliberately avoiding vendor lock-in.
Makes sense. Don't put all your eggs in one basket.
Exactly.
Yeah.
A recent survey shows 74% of enterprises now use a multi-cloud strategy, combining services from different providers. And hybrid cloud, which seamlessly blends on-premise infrastructure with public cloud, remains the most popular deployment model overall.
Why is that?
It's driven by a desire for best-of-breed services from different providers, significant cost optimization, and enhanced resilience for disaster recovery.
Right.
However, this flexibility introduces complexities like managing disparate environments and controlling those escalating data egress fees
The hidden costs.
that providers charge for moving data out of their clouds.
Okay, and the third trend?
And third, edge computing. With the explosion of data from billions of IoT devices, think smart factories, autonomous vehicles, connected cities, even smart agriculture computation is fundamentally moving closer to the source of data generation.
Closer to where the data is.
Precisely. It's projected that by 2025, a significant 75% of enterprise-generated data will be processed outside traditional centralized data centers or public clouds. This drives the market forecast to grow at a 13.0% CAGR, creating immense demand for edge-native databases and applications that can operate with ultra-low latency, real-time processing, and even intermittent connectivity.
So if I'm understanding this right, we have this fascinating, almost paradoxical convergence. On one hand, intense AI computation is pushing workloads to massive centralized public clouds for sheer scale. But simultaneously, the imperative of data sovereignty, privacy, and ultra-low latency is pulling data processing to localized and highly distributed infrastructures closer to the source. That's a truly complex dance for enterprises trying to balance innovation with compliance and performance. It sounds like a huge challenge for cloud providers to navigate.
You've articulated that perfectly. And this complexity means that cloud providers who can truly deliver high-performance AI infrastructure across a wide array of deployment models, including public cloud regions, dedicated regions within a customer's data center, what Oracle calls cloud at customer, and specialized sovereign clouds for sensitive workloads. Those are the providers best positioned to capture this multifaceted, distributed demand. It's no longer a one-size-fits-all world. It's about meeting customers exactly where their specific regulatory, performance, and data residency needs are.
Speaking of data sovereignty, how do global regulations factor into this massive shift? It sounds like a non-negotiable consideration for any company operating internationally, and certainly for a global tech giant like Oracle.
It's a foundational factor, truly. A tightening global regulatory environment significantly impacts cloud adoption strategies and the very architecture of cloud services. Data privacy regulations like the GDPR in Europe and the CCPA in California, they're no longer optional.
Not anymore.
They're critical legal and business prerequisites for doing business globally, imposing strict rules on how personal data is collected, processed, and stored. Violations carry severe penalties.
And here's where it gets really interesting for cloud providers. Data sovereignty.
Yes.
The principle that data is subject to the laws and governance structures of its collected nation is increasingly compelling governments worldwide to mandate in-country storage and processing. This isn't just about privacy, it's about national control over critical data assets and digital infrastructure.
Absolutely. This trend forces global cloud providers to heavily invest in building out regional data centers, often within specific national borders, to meet these strict data residency requirements. For instance, Oracle has explicitly launched a dedicated EU sovereign cloud designed from the ground up to meet the most stringent European data governance rules.
Okay.
Similarly, Microsoft has expanded its Azure presence in Saudi Arabia to meet local mandates. This creates both a significant capital expenditure burden for these cloud providers, requiring massive upfront investments.
A big cost.
A huge cost. But it also creates a substantial competitive advantage for those, like Oracle, who can successfully navigate this complex and fragmented regulatory landscape and offer compliant solutions globally. It's a strategic differentiator.
Oracle's position in the market is truly fascinating. It's both a legacy leader defending its deeply entrenched turf, like a wise old king in his historical castle, and simultaneously an aggressive challenger storming the gates of a new, highly competitive market. So how do they actually stack up against the competition in these different segments? Let's break it down.
Okay. When we look at cloud infrastructure, or IaaS, it's undeniably an oligopoly dominated by the big three hyperscalers. AWS leads with approximately 33% market share. Then you have Microsoft Azure at 21%, and Google Cloud, or GCP, with 11-12%.
The usual suspects.
Usual suspects. Oracle, while growing at an exceptionally rapid pace, is still a much smaller player in this segment, with an estimated market share of around 3%.
Only 3%.
Around 3%. The insight here is that while they are gaining significant ground, they are starting from a considerably smaller base in the IaaS battle. Their growth rates have to be much higher just to catch up.
Now let's talk about Oracle's historical castle, their absolute stronghold, database management. Are they still king of the hill here, or are newer cloud-native and open-source alternatives finally eroding their dominance?
In terms of the total database market, the answer is still yes. The DB Engine's ranking, which tracks popularity and market presence, consistently places Oracle at #1 globally.
Still number one.
Still number one. This is largely due to their deeply entrenched dominance in on-premise relational databases, which, remarkably, still hold that majority 58% of the total DBMS market. Many of the world's largest enterprises literally run on Oracle databases. However, in the cloud, Oracle faces fierce competition from the hyperscalers' native database offerings like AWS Aurora and Azure SQL Database, and also from fast-growing NoSQL players like MongoDB, which are designed for different types of data and workloads like big data and mobile applications. So while they're still king overall, The battle for the cloud database crown is far from over, and it's a critical fight for them to win.
Okay, what about applications? SaaS.
Moving to enterprise applications, or SaaS, it's a segmented and varied picture for Oracle. In ERP, or enterprise resource planning, it's a remarkably tight race for market leadership. Recent 2024 data shows Oracle narrowly overtaking SAP in ERP software revenue, reporting $8.7 billion compared to SAP's $8.6 billion.
Neck and neck.
Pretty much. This gives them each about 6.6% market share, effectively making it a tie for the top spot. This really highlights the significant success of Oracle's cloud-native Fusion and NetSuite applications in gaining traction and market share against a formidable rival.
So they're making real inroads there.
Definitely. However, in CRM, or Customer Relationship Management, the story is quite different. Salesforce unequivocally dominates this market with a staggering 20.7% market share,
Way ahead.
which is more than the combined share of its next four closest competitors. Oracle is a distant challenger here, with a single-digit market share battling for a much smaller piece of the pie. Their strategy here is less about outright market dominance and more about integration, which we'll discuss shortly.
Okay.
Now, to discuss Oracle's most durable competitive advantage, their true strategic moat. It has to be its decades-long leadership in relational database technology. The Oracle database is, quite literally, the system of record for critical operations at thousands of the world's largest enterprises, from banking and telecommunications to retail and government. It's the engine that powers their core mission-critical businesses.
So if you're a massive established company already running your most sensitive, deeply integrated transactional systems on Oracle, it must be incredibly difficult to switch to something else, right? It's not like changing your email provider. It sounds like open heart surgery for a corporation.
You've hit the nail on the head.
Yeah.
Migrating complex, deeply integrated transactional systems off Oracle database is not just difficult, it's inherently risky, incredibly expensive, and immensely time-consuming.
Yeah, I bet.
Few large organizations are willing to undertake such a disruptive endeavor unless absolutely forced to by extreme cost or performance issues. This stickiness, these incredibly high switching costs, provide Oracle with a highly predictable and remarkably profitable revenue stream from those ongoing license support contracts. This is the core economic moat that continues to generate significant cash flow for the company, even as they transition to the cloud. It's a foundational asset.
Oracle's approach is somewhat unique in that it offers a fully integrated technology stack, from silicon to applications. They aim to provide everything a company needs. What's the core value proposition there for customers? Why would a company choose that all-in-one approach over assembling disparate pieces from different vendors, what we call a best-of-breed strategy?
The idea behind Oracle's integrated stack is to offer seamless integration, a unified data model across an entire enterprise, and crucially, a single vendor for all support and accountability.
One throat to choke, as they say.
Exactly. This means everything from the underlying hardware, the silicon, to the infrastructure, platform services, and a comprehensive suite of SaaS applications like Fusion Cloud, ERP, HCM, SCM, and CX. They're all designed to work together out of the box. For customers, this theoretically translates into a lower total cost of ownership compared to trying to assemble a bespoke solution from multiple best-of-breed vendors, each with their own contracts, support lines, and the often nightmarish challenges of integrating them.
Right, the integration headache.
It's a key differentiator against competitors who specialize in just one layer, like Salesforce and CRM or AWS and IS. It's about simplicity and certainty for complex enterprises. Let's delve into how Oracle benchmarks against its key rivals in these specific hotly contested areas. When we look at AWS, Azure, and Google Cloud and IS, Oracle readily admits it cannot compete on sheer scale. Certainly not yet.
Okay.
Their strategy isn't to be the biggest, but to be the best for specific, demanding workloads. They compete intensely on performance and price, especially for their own database workloads, and for high-performance computing, HPC, and AI training. Oracle's Gen 2 cloud infrastructure was specifically designed with architectural advantages such as off-box network virtualization and non-oversubscribed, low-latency networks.
What does that mean in plain English?
What this technical jargon really means for you as a customer is that your compute resources get dedicated network bandwidth, avoiding the noisy neighbor problem common in multi-tenant clouds.
Ah, so consistent performance.
Exactly. Oracle claims these provide superior and more consistent performance for demanding enterprise applications, making them uniquely sticky for core business applications where reliability is paramount. In the ERP space versus SAP, the competition is a strategic battle for the heart of the enterprise. Oracle argues that its Fusion Cloud ERP, which was built from the ground up for the cloud, offers greater agility, a more frequent innovation cycle with quarterly updates, and a truly unified data model across the enterprise.
Versus SAP's approach.
SAP's offerings, by contrast, are often a hybrid of on-premise and cloud components, which can require more complex migrations for customers. Oracle posits that Fusion is inherently more nimble and cloud-native, offering a faster path to digital transformation.
Okay, makes sense. And CRM versus Salesforce.
And finally, versus Salesforce and CRM, Oracle's competitive angle is not necessarily to beat Salesforce on standalone CRM features. Salesforce is the pure-play leader there, no doubt. Instead, Oracle's value proposition is to offer a CRM solution that is deeply natively integrated with its comprehensive suite of other enterprise applications, its ERP, SCM, and HCM systems. This provides a truly 360-degree view of the customer that spans from initial marketing and sales all the way through finance, order fulfillment, and even human resources.
Connecting the dots across the business.
Precisely. This integrated proposition can be incredibly compelling for large enterprises that are already standardized on Oracle's back-office systems, seeking a holistic view of their entire operations rather than siloed departments.
So it sounds like Oracle isn't just trying to outspend or outscale the giants like AWS or Microsoft. What are the key elements of Oracle's specific strategy to truly stand out in this incredibly crowded, hyper-competitive market? What's their unique recipe for differentiation that they believe will allow them to win?
It's multifaceted, incredibly nuanced, and frankly, quite audacious. First, they emphasize aggressive price performance. Oracle explicitly markets OCI as offering superior price performance, especially when it comes to networking. They claim data egress costs, that is, the cost of moving data out of their cloud, are up to 13 times lower than AWS.
13 times. That's a big difference.
It's huge. This is a critical factor for data-intensive and multi-cloud workloads because those egress fees can quickly add up and become a significant, often hidden cost that bites into a customer's budget. Lower egress costs make multi-cloud strategies far more economically viable.
Okay.
Second is deployment flexibility, or their distributed cloud model. Oracle has built its entire cloud strategy around offering customers maximum choice in how and where they deploy their workloads. They claim to be the only hyperscaler capable of delivering their full portfolio of over 200 cloud and AI services across multiple models. Public cloud regions, dedicated regions within a customer's own data center, which they call cloud at customer.
Bringing the cloud in-house, basically.
Exactly. Air-gapped clouds for highly sensitive workloads that need complete isolation, and partner-operated sovereign clouds, Alloy, which are essential for meeting specific national data residency and governance requirements.
Alloy. What's that?
Alloy is Oracle empowering partners to run sovereign clouds using Oracle tech, further expanding their reach to meet unique national requirements without Oracle building everything itself.
Interesting.
Think of Cloud at Customer as bringing the full power of Oracle's public cloud right into your data center, managed by Oracle, ideal for companies with strict data residency rules or latency needs. This directly addresses the growing enterprise need for solutions that cater to data sovereignty, low latency, and regulatory compliance. It's a very nuanced, customer-centric approach.
And the third element, you said it was intriguing.
And third, which is perhaps the most intriguing and strategically brilliant, is their unique multi-cloud strategy. Here's where it gets really interesting. Oracle has started offering its flagship database products, including its cutting-edge autonomous database and high-performance Exadata systems. Darrow run as managed services on OCI hardware co-located within the data centers of its direct competitors, specifically Microsoft Azure and soon, potentially, AWS.
Wait. So they're putting their best stuff inside Azure data centers, running Oracle databases on Azure infrastructure.
Not quite on Azure infrastructure, but on OCI hardware physically located within Azure data centers. So you get the Oracle performance right next to your Azure applications.
Okay, that's wild. Effectively turning their fiercest competitors into partners to protect and even expand their core business. That is a bold, almost counterintuitive move that flies in the face of traditional tech rivalries.
It absolutely is. This database and strategy, as they call it, is a pragmatic acknowledgement of the multi-cloud reality. Many enterprises run their applications on AWS or Azure, but have been reluctant to move their existing mission-critical Oracle databases to OCI due to concerns about latency between the application and database and those aforementioned data transfer costs.
Right. The performance hit and the cost.
Exactly. By placing its database service directly next to the applications within the competitor's data center, Oracle effectively eliminates these barriers. This maneuver is designed to defend their incredibly lucrative database franchise from cloud-native alternatives while simultaneously opening a completely new revenue stream on competitor platforms.
Wow.
And the results? The staggering 115% sequential growth in multi-cloud database revenue reported in Q4 FY25 provides early, significant validation of this highly strategic approach. It's a defensive move that has turned into an offensive play.
Now let's talk numbers. All this strategy and transformation sounds impressive on paper, but how has it actually impacted Oracle's financials? And more importantly, where are they heading financially? Has this massive pivot actually translated into growth? Because for a long time, they were kind of flat, weren't they?
That's exactly right. For a long time, Oracle's revenue growth was notably flat, which was definitely a concern for investors. If you look at their total revenue from fiscal year 2015, which was around $38.2 billion, to fiscal year 2021, at $40.5 billion, their compound annual growth rate was less than 1%.
Less than 1% over 6 years? Ouch!
Yeah, this period was characterized by the managed but significant decline of their high-margin upfront license model, which was only slowly being offset by the initial ramp-up of cloud subscription revenues. It was a period of deliberate yet financially sluggish transition as they navigated this complex business model shift.
So when did the tide truly start to turn? When did we really begin to see the results of this massive pivot in their financial statements?
We saw a clear inflection point occur in fiscal year 2023. That's when annual revenue jumped a significant 17.7% to nearly $50 billion.
A big jump.
A very big jump. This acceleration was driven by two key factors: accelerating cloud adoption across their entire portfolio, particularly OCI, and the inclusion of revenue from the newly acquired Cerner healthcare business. This momentum has continued, reaching $57.4 billion in total revenue for fiscal year 2025.
Okay, so the growth is definitely there now.
Definitely. This isn't just incremental growth. It's a fundamental shift in their financial trajectory, demonstrating that the cloud strategy is truly taking hold.
How are they measuring this critical shift to recurring cloud subscriptions? And what are the most important financial indicators of this transformation? For us, the learners, what are the signals to look for in their reports?
The most critical measure is indeed cloud revenue growth, and even more importantly, the growth in their remaining performance obligations, or RPO.
RPO.
In Q4 fiscal 2025, Oracle's total cloud revenue, which combines both IaaS and SaaS, reached $6.7 billion, up a very strong 27% year over year.
27%. Solid.
Very solid. And this growth is bifurcated, revealing their core growth engines. Cloud infrastructure, or IaaS, is surging, up an impressive 52% to $3.0 billion, making it the high-growth accelerator.
52% for IaaS.
Yeah, that's the engine. Meanwhile, the larger, more mature cloud application, or SaaS, business grew at a solid but more moderate 12% to $3.7 billion. This highlights OCI as the future growth accelerator for the entire company.
But you mentioned RPO was even more important.
Yes, arguably the most important leading indicator is that remaining performance obligation, or RPO. This metric represents the total value of contracted future revenue that Oracle has signed but is not yet recognized. Think of it as their future revenue backlog.
So deals they've closed but haven't billed yet.
Exactly. In Q4 FY25, RPO surged a massive 41% year over year to a staggering $138 billion.
$138 billion.
Billion. This is not just a big number. It means Oracle is successfully signing very large, long-term cloud contracts at a rate significantly outpacing their current recognized revenue growth. This provides incredibly strong visibility into future revenue streams and validates management's aggressive growth target.
That's a huge backlog.
It is. In fact, management even projects that RPO could grow by over 100% in fiscal year 2026.
Double again.
Which would suggest a truly massive acceleration in new business bookings and pipeline for the company.
So with all these massive contracts being signed and this undeniable momentum, what are the specific pillars driving this future growth for Oracle? What are the key engines that will accelerate them into the cloud economy?
There are three core pillars that are going to dictate Oracle's growth trajectory going forward. First, and unequivocally now, is Oracle Cloud Infrastructure, or OCI. This is their primary growth engine. Management has provided aggressive guidance for OCI revenue growth to accelerate from around 50% in FY25 to over 70% in FY26.
70% growth for IaaS? That's hyperscale speed.
That's the goal. This hypergrowth is fueled by two main sources. The massive, almost insatiable demand for high-performance AI training infrastructure, which we discussed,
Right, the AI gold rush.
and the ongoing large-scale migration of traditional enterprise workloads from on-premise data centers to OCI as companies modernize their operations.
Okay, pillar one is OCI. What's two?
The second pillar is the autonomous database. This is a key technological differentiator for OCI. It's a self-driving, self-securing, and self-repairing database service.
Self-driving database. How does that work?
The idea is to drastically reduce the administrative overhead and human error associated with managing complex databases, which can be a huge hidden cost for enterprises. Imagine a database that patches itself, tunes itself for performance, and protects itself from security threats without significant human intervention.
That sounds really appealing for IT departments.
It's extremely appealing. While Oracle doesn't break out specific revenue for this service, its strong adoption with thousands of customers and a high volume of free trials is consistently highlighted by management as critical for driving overall OCI consumption. It's a crucial lure for customers moving their most critical data to Oracle's cloud.
Got it. And pillar through.
And the third pillar is their cloud applications, or SaaS, business. Oracle's two flagship ERP products continue to deliver strong and durable growth. Their Fusion Cloud ERP, which targets large enterprises, grew a healthy 22% in Q4 FY25.
Still very strong.
And NetSuite Cloud ERP, which focuses on the mid-market, grew 18%. This consistent performance indicates that Oracle is successfully gaining market share in the core enterprise application space, often at the expense of legacy on-premise systems from competitors like SAP. They're effectively modernizing the back office for their large installed base of customers by moving them to the cloud.
Beyond these core growth engines, you mentioned Oracle is making two huge transformative bets that could truly redefine their future and open up entirely new segments of the market. What are they?
That's absolutely right. First is AI infrastructure. Oracle is aggressively investing to become a premier infrastructure provider for the AI revolution. They're leveraging OCI's high-performance RDMA cluster networking. Think of RDMA as a superhighway for data within their cloud, allowing AI models to communicate with near-zero delay.
Okay, faster communication for AI training.
Crucial for training massive large language models because it means less waiting and more actual computation, a key reason AI companies are flocking to OCI. They've already secured significant contracts with leading AI companies, including a widely reported $30 billion deal with OpenAI.
30 billion with OpenAI.
Yeah, it's the reported number, yes. And they are rapidly expanding their data center capacity with tens of thousands of NVIDIA GPUs. This strategy aims to capture a significant share of the burgeoning enterprise AI market, which, as we discussed, is set for truly explosive growth.
Okay, that's a huge bet on AI. What's the second big bet?
The second major bet is healthcare, specifically through the Cerner acquisition. The $28.3 billion acquisition of Cerner in 2022 was a truly bold move, intended to establish a dominant position in the massive healthcare technology vertical.
A whole new industry for them, essentially.
A massive one.
Yeah.
The strategic rationale is to modernize Cerner's electronic health records, or EHR, platform by migrating it entirely to OCI and embedding next-generation technologies like AI, machine learning, and voice interfaces.
AI and healthcare records, that sounds promising, but also complex.
Extremely complex. The long-term vision is quite ambitious, to create a unified national health records database.
Wow.
While the integration of Cerner has initially acted as a drag on Oracle's overall growth and margins.
Which you'd expect with the big acquisition.
Exactly. Management explicitly expects Cerner to become a significant growth driver in FY26 and beyond as the migration completes and synergies are realized. This could be a huge new market for Oracle.
All this sounds like a monumental amount of investment, building new cloud infrastructure, integrating a massive acquisition, investing heavily in AI. What does their R&D pipeline look like to support all this innovation and growth? Where are they pouring their research dollars?
Oracle's growth strategy is indeed underpinned by substantial and sustained investment in research and development. The company has invested over $80 billion in R&D since fiscal 2012, which is a testament to their long-term commitment to innovation.
$80 billion, that's serious commitment.
It is. Their current innovation pipeline is heavily focused on integrating AI across their entire product portfolio. This includes embedding generative AI features directly into their Fusion Cloud applications, like the Ledger AI agent for finance.
What does that do?
Imagine an AI not just crunching numbers, but proactively identifying financial anomalies and suggesting optimal actions, fundamentally changing how finance teams operate.
Okay, smart applications.
And they're developing advanced AI capabilities within their core database. such as the AI vector search in Oracle Database 23i.
Vector.
It allows you to query your vast databases using natural language, like simply asking a question and getting a direct answer, completely transforming how you interact with data. So it's not just about providing the infrastructure for others' AI. It's about embedding AI directly into their own products, making them smarter and more powerful.
This whole transformation, especially building out global cloud infrastructure at this scale, sounds incredibly expensive. How is Oracle actually funding this enormous undertaking, and what does that mean for their overall financial strategy? Are they fundamentally changing how they manage their money?
You're absolutely right. It's a massive multi-year undertaking. Historically, Oracle was a capital-light, incredibly high-margin software company. They generated substantial free cash flow, which was primarily deployed for large-scale share repurchases, rewarding shareholders, and strategic acquisitions to grow their software portfolio.
The classic Oracle playbook.
Exactly. However, building a globally competitive cloud infrastructure has forced a fundamental, almost philosophical change in this capital allocation strategy.
So, if I'm understanding this right, the Oracle playbook, that consistent drumbeat of massive share buybacks, is fundamentally changing. Where is all that cash flow actually going now? Are they really opening up the checkbook for infrastructure?
Unprecedentedly big, yes. They're in the midst of a massive capital expenditure cycle to build new data centers globally and acquire the necessary hardware, especially those high-demand NVIDIA GPUs, to meet the surging demand for OCI and AI services.
How big are we talking?
In fiscal 2025, their CapEx surged to $21.2 billion, which was well ahead of their own guidance.
$21 billion on CapEx.
And it's expected to exceed $25 billion in fiscal 2026. This level of spending, representing approximately 37% of their FY25 revenue, is actually the highest among hyperscalers as a percentage of revenue.
Higher than AWS or Azure as a percent of revenue.
As a percentage, yes. This isn't just an investment. It signals an all-in commitment to winning in the cloud infrastructure market, a dramatic departure from their past.
Okay, so huge spending. What about shareholder returns? Are buybacks and dividends totally gone?
Not totally gone, but definitely moderated. Despite this massive spending, Oracle has a long, consistent track record of returning capital to shareholders. They have a clear policy of paying a quarterly dividend and have actually increased their quarterly dividend for 11 consecutive years.
Okay, dividend growth is still there.
Yes, the current annual dividend is $2 per share, which translates to a yield of approximately 0.8%. The dividend payout ratio stands at a sustainable 38–40% of earnings, suggesting it's well covered and has room for future growth. While historically they were one of the most aggressive stock repurchasers in the technology sector, that activity has naturally moderated significantly as they prioritize funding these critical infrastructure investments and prudently managing their debt load. The focus has truly shifted to growth investments.
Acquisitions have always been a cornerstone of Oracle's playbook, from PeopleSoft to Sun Microsystems. How does that fit into the current strategy, especially with this huge focus on organic growth in cloud? Are they still shopping?
Acquisitions have indeed been a cornerstone of their growth strategy for decades. The company spent over $110 billion on more than 150 deals, using M&A to enter new markets, acquire key technology, and consolidate the industry.
It's in their DNA.
Absolutely. Early ones like PeopleSoft, Siebel Systems, and Sun Microsystems were instrumental in building Oracle's comprehensive enterprise application and technology portfolio. More recently, cloud-era acquisitions like NetSuite in 2016 for $9.3 billion immediately gave Oracle a leading position in cloud ERP for the mid-market.
Right, NetSuite was big.
And then, of course, the landmark $28.3 billion Cerner acquisition in 2022 represents that massive strategic bet on dominating the healthcare technology vertical with cloud-based solutions. So M&A continues to be a critical accelerant to their pivot, even as they prioritize organic cloud build-out.
A company spending this much on capital expenditures and doing such significant acquisitions, what does their balance sheet look like? Is it stretched, or are they managing this leverage effectively?
Oracle employs a significantly leveraged balance sheet to fund these strategic long-term initiatives. As of the most recent fiscal year, the company reported total debt of $92.6 billion.
$92 billion in debt. That sounds like a lot.
It is a large number, resulting in a high debt-to-equity ratio of 441.5%. Now, while this level of leverage appears quite high on the surface, it's largely considered manageable by analysts who cover the company.
Why is that?
Their debt is well covered by substantial operating cash flow, with a 22.5% coverage ratio, meaning they generate significantly more cash from operations than they need to cover their debt. and their interest payments are comfortably covered by EBIT, or earnings before interest and taxes, at 6.0x coverage.
Okay, so they can handle the payments.
Comfortably. This indicates that the company generates more than enough profit in cash to comfortably service its debt obligations. This leverage has been a strategic tool, allowing them to finance value-creating acquisitions and unprecedented infrastructure investments without unduly stressing their financial health.
So it's a strategic use of leverage. Effectively, the cash that used to fuel those massive share buybacks is now largely being redirected into building this massive global cloud infrastructure, fundamentally changing their financial profile and investment priorities. That's a huge shift for long-term Oracle watchers.
It really is a fundamental change in philosophy.
A transformation of this magnitude, shifting from a legacy on-premise model to a capital-intensive cloud infrastructure provider, while integrating a massive healthcare acquisition requires exceptional leadership and operational discipline. How does Oracle stack up in that regard? Do they have the right people at the helm to pull this off successfully?
Oracle's leadership is indeed defined by the unique, long-standing, and almost legendary partnership of its founder, Larry Ellison, and CEO Safra Catz. This isn't your typical corporate structure, and their synergy is undeniable.
Ellison and Katz, a powerhouse duo.
Absolutely. Larry Ellison, as chairman and CTO, is the undeniable visionary force behind Oracle. His career shows an uncanny ability to identify tectonic shifts from relational databases to the internet, and now cloud and AI, and to make incredibly bold, often contrarian strategic bets to position Oracle for the future.
Always looking ahead.
Always. His style is known to be autocratic, intensely competitive, and singularly driven by a desire to win, which has fueled Oracle's aggressive M&A strategy and its relentless focus on technological superiority. He's the one charting the grand course.
And Safra Catz.
Complementing Ellison, Safra Catz, as CEO, provides the operational and financial stewardship. She's the one translating Ellison's grand vision into reality, meticulously overseeing the financial discipline, operational efficiency, and critical customer success. She joined Oracle way back in 1999 and has been the architect of over 130 acquisitions, integrating them into the Oracle fold.
Wow, 130 acquisitions.
Her focus is on the execution, ensuring that investments are aligned with long-term profitability goals and steering the highly complex cloud transition day to day.
So you effectively have a long-term technology visionary who's always thinking 5, 10, 20 years ahead, paired with an incredibly disciplined financial operator who has overseen countless complex integrations and manages the company's P&L. That's a powerful, almost symbiotic combination that you rarely see in big tech.
It truly is, and it's a distinct characteristic of Oracle's management that has served them well for decades. Now, while Oracle doesn't publicly disclose all internal operational metrics, such as granular customer retention or sales efficiency, we can infer a lot from the available data.
Okay, what can we infer?
For their legacy license support business, renewal rates often exceed 90%. Showing incredible customer loyalty and the stickiness of their core database.
Still over 90%. Impressive.
Very. For the cloud business, while no direct net revenue retention, or NRR, is publicly reported, the explosive growth in remaining performance obligations and OCI consumption strongly implies a very healthy NRR, likely well above the 100% benchmark.
Meaning customers are spending more over time.
Exactly, indicating significant customer expansion and cross-selling within their cloud services. For example, revenue from their cloud at customer deployments, which bring OCI into customer data centers, saw remarkable 104% year-over-year growth, indicating strong expansion within that existing base.
What about sales costs? Are they efficient?
Regarding sales efficiency and customer acquisition cost, CAC, a key element of Oracle's strategy is to leverage its vast existing on-premise customer base for cloud cross-selling. This should, in theory, result in a structurally lower CAC compared to cloud-native competitors who must acquire every customer from scratch in a highly competitive market.
Tapping into their installed base.
Precisely. Their sales and marketing expenses as a percentage of revenue have been trending downwards, which suggests improving efficiency even if we don't have the explicit CAC numbers. It implies they are getting more bang for their buck.
Okay, and margins. That's the big question with the shift to IaaS.
Then there are the margin trends. This is critical to watch because it reflects the economics of their transformation. The strategic shift in revenue mix from high-margin on-premise licenses to the lower-margin IaaS business has naturally compressed Oracle's overall consolidated gross margin. It's declined from over 80% in FY 2021 to around 70.5% for the trailing 12 months ending May 2025.
That's a significant drop.
It is, but it's an expected consequence of the capital-intensive nature of cloud infrastructure compared to traditional software licensing. However, management expects IS gross margins to improve significantly as new data centers reach higher utilization rates, which is a key assumption for their long-term profitability.
So scale should help margins eventually.
That's the plan.
Right.
Importantly, their non-GAAP operating margin has remained strong at a healthy 44% in both FY 2024 and Q4 FY 25, indicating good cost control despite the massive investments in new infrastructure.
So they have the visionaries and the operators, but how good are they at actually executing on these massive plans, especially with such huge capital expenditures and complex integrations like Cerner? What are the biggest operational challenges? Where could things go wrong?
Oracle has a demonstrated history of executing complex strategic initiatives. Their track record of successfully integrating dozens of large acquisitions is a core competency they've honed over decades. However, the current imperatives, the full integration of Cerner and the massive global data center build-out represent their most significant operational tests in recent history.
So Cerner first. How's that integration going?
Cerner integration isn't just about merging companies. It's a deeply complex technical migration of Cerner's entire electronic health records application suite to OCI. This isn't a quick lift and shift. It involves re-architecting systems and ensuring seamless continuity for millions of patient records.
High stakes for patient data.
It's extremely high stakes. Success will be measured not just by cost synergies, but by a demonstrable return to growth for their health division and successful modernization of the platform. It's a multi-year effort.
And the data center build-out.
And the data center expansion is truly a race against time as well as logistical marvel. The planned expenditure of over $25 billion in fiscal year 2026 alone is staggering. This ambitious plan faces significant execution risks, including potential construction delays, supply chain disruptions, especially for those in-demand GPUs.
Getting enough GPUs is a challenge for everyone right now.
It is, and the ever-present risk of cost overruns. Failure to bring this critical computing capacity online quickly and efficiently could directly prevent them from converting that massive RPO backlog into recognized revenue, severely jeopardizing their growth narrative and damaging their credibility as a top-tier hyperscale cloud provider. It's a high-stakes operational game.
We've discussed Oracle's ambitious strategy and their operational execution, but what does it all mean for Oracle's actual financial performance and, crucially, how the market values the company right now? Are investors truly seeing this transformation reflected in stock price? Let's get into the valuation.
Okay, Oracle's revenue is primarily driven by its cloud services and license support segment, which now accounts for a significant 74% of total revenue in Q4 FY25. Up from 68% just a year prior.
So cloud and support are the vast majority now.
The vast majority. This robust cloud growth is more than offsetting the planned and expected decline in their traditional cloud license and on-premise license segment, demonstrating a successful intentional revenue mix shift. The smaller hardware and services segments have remained relatively stable contributors, but are not key growth drivers.
And what about the impact on profitability? Are these new cloud revenues as profitable as their legacy business, or are we seeing a trade-off for growth?
The shift to the lower margin IS business has, as expected, compressed Oracle's overall consolidated gross profit margin. It's fallen from 80.6% in FY 2021 to 70.5% for the trailing 12 months ending May 2025.
We talked about that drop. Is it stabilizing?
It seems to be finding a level, but the key is future improvement. This is a direct consequence of the capital-intensive nature of cloud infrastructure compared to traditional software licensing, where the cost of goods sold is much lower. However, Oracle has maintained strong operating discipline, with that non-GAAP operating margin holding steady at 44% in both FY 2024 and Q4 FY 25.
So they're managing costs well despite the lower gross margin.
Exactly. The key going forward is whether they can achieve significant economies of scale in their cloud operations to improve those IS gross margins over time. This will be absolutely crucial for overall corporate profitability and validating the long-term economics of this strategic pivot.
What about return metrics, like ROIC or ROE?
Calculating precise return on invested capital, or ROIC, or return on equity, ROE, is complex for Oracle due to several balance sheet factors. They carry substantial goodwill from decades of acquisitions and a large amount of treasury stock from past share buybacks that impacts the equity calculation.
Makes the math tricky.
Very tricky. Directionally, however, returns have been under pressure during this peak investment phase, which is to be expected when you're undergoing such a massive capital expenditure cycle to build out new infrastructure. The forward-looking question, and the one investors need to ask, is whether these massive data center investments will ultimately generate returns that meaningfully exceed the company's cost of capital.
That's the million, or rather billion-dollar question.
Precisely. That's the ultimate test of this transformation strategy's financial success.
So, considering all these moving parts, how is the market actually valuing this transforming company right now? What do the various valuation multiples tell us about how investors are perceiving Oracle's future?
A multifaceted approach is absolutely needed to value Oracle. If we look at multiples analysis, Oracle's trailing 12-month TTM price earnings, PE ratio, is approximately 53.4x.
53 times earnings. That sounds high for Oracle historically.
It is. It's significantly higher than its historical 10-year average of 26.8x, which clearly signals that the market is pricing in substantial future earnings growth, primarily from the accelerating cloud and AI businesses.
So the market believes in the growth story to some extent.
To a large extent. Its
Yes.
forward PE, based on next 12-month estimates, is a more moderate 33.2x. Their forward enterprise value to EBITDA multiple, is around 26.9x, which reflects their significant debt load, as enterprise value includes debt.
What about other methods like DCF?
For a discounted cash flow DCF analysis, this is a highly sensitive valuation methodology as it relies heavily on future assumptions.
Garbage in, garbage out, right?
Pretty much. Key inputs for an Oracle DCF model would include assumptions for high double-digit revenue growth in the medium term, gradually improving operating margins as the cloud business scales, elevated capital expenditures for the next few years, likely FY25 through FY27, and then normalizing to lower levels. One public model, for instance, suggests a DCF value of approximately $146 per share, which, if accurate, would imply the stock might be overvalued by this metric alone at its current price.
Potentially overvalued by DCF.
Potentially, but again, DCF models are only as good as their assumptions. Small changes in growth or discount rates can dramatically alter the outcome.
How does Oracle's valuation compare to its rivals, both legacy software players like SAP and the dominant cloud giants like Microsoft and Salesforce? Is the market treating them like a new cloud growth company or still weighing them down with legacy player label?
That's the critical question for investors. When we benchmark Oracle against its peers, we see a clear dichotomy. Oracle trades at a premium to traditional enterprise software peers like SAP, reflecting its stronger growth prospects and strategic moves into new, higher growth markets like cloud infrastructure and AI.
Okay, better than legacy peers.
Yes. However, it still trades at a noticeable discount to more dominant pure-play cloud and SaaS players like Microsoft and Salesforce on a PE basis.
But cheaper than the big cloud guys.
Correct. Its EV/EBITDA multiple is higher than many peers, which again reflects its significant debt load. The market appears to be valuing Oracle as a hybrid entity, part stable legacy software company with predictable cash flows, and part high-growth cloud challenger that requires massive investment.
A blend.
A blend. The investment case hinges critically on whether this accelerating cloud growth ultimately leads to a higher, more definitively cloud-like valuation multiple for the entire company, or if the inherent risks keep that valuation in check.
No investment analysis is complete without a rigorous, unblinking look at the risks. What could derail Oracle's ambitious transformation, and what are the biggest headwinds they face that could truly jeopardize this massive bet?
Absolutely. There are significant business and competitive risks that could challenge their trajectory. First and foremost is the intense competition. The cloud infrastructure market is hyper-competitive, an oligopoly dominated by giants.
AWS, Azure, Google Cloud.
Exactly. Oracle competes against AWS, Microsoft, and Google, who all have significant first-mover advantages, vastly greater market share, and truly enormous R&D budgets. This intense environment could lead to aggressive price wars and ongoing market share loss, especially if Oracle can't consistently maintain its differentiated performance claims or scale as rapidly as demand dictates.
Hard to compete with those giants head-on.
Very hard. Then there's technological disruption. The pace of innovation in enterprise technology is incredibly rapid. The current generative AI boom, while transformative for Oracle, could potentially be supplanted by something entirely new, and if Oracle fails to adapt quickly, its massive investments in AI infrastructure could become obsolete or less relevant.
The next big thing could leave them behind.
Potentially. There's also the persistent threat from open-source alternatives to its commercial software, particularly in the database market, which continues to put pricing pressure on their traditional stronghold.
Right.
And finally, cloud transition execution itself carries considerable risk. Flawlessly managing the delicate decline of their highly profitable on-premise business while simultaneously rapidly scaling their cloud offerings is incredibly challenging. It's a tricky balancing act.
Juggling decline and growth.
Exactly. There's also a customer concentration risk in its AI infrastructure business, where a few very large customers like OpenAI could represent a significant portion of revenue, making the business vulnerable if those relationships sour or if demand shifts suddenly.
Okay, those are business risks. What about financial risks?
From a financial risks perspective, Oracle's high debt levels are certainly a factor that bears watching. At $92.6 billion, Oracle's debt reduces their financial flexibility. While currently manageable due to strong cash flow, a significant downturn in the business or a sharp rise in interest rates could make servicing it more burdensome and limit the company's ability to invest further or return capital to shareholders.
Rising rates could definitely hurt with that much debt.
Absolutely. We also have margin pressure. The strategic shift to IaaS, which inherently has lower gross margins than traditional software licensing, could permanently compress Oracle's overall profitability. If it can't achieve significant economies of scale in their data center operations, or if they're forced into intense price wars by competitors, those corporate margins could face sustained pressure, impacting long-term profitability.
And global operations mean currency risk too, right?
Yes. As a truly global company with significant international operations, foreign exchange exposure means currency fluctuations can always create volatility in their reported results, acting as a headwind or tailwind that is outside their direct control.
These next set of risks, especially those related to execution and integration, seem like the most immediate and tangible given their current strategy and massive investments they're making. This is where the rubber hits the road, isn't it?
They absolutely are. The data center build-out represents a monumental undertaking. The planned expenditure of over $25 billion in fiscal 2026 is staggering. This ambitious plan faces significant execution risks, including potential construction delays, supply chain disruptions, especially for those in-demand GPUs,
To GPU bottleneck again?
and the ever-present risk of cost overruns. Failure to bring this critical computing capacity online quickly and efficiently could directly prevent them from converting their massive RPO backlog into recognized revenue, severely damaging their growth narrative and credibility with investors. It's a huge ongoing challenge.
And Cerner, still integrating that beast.
And then there's the acquisition integration, specifically of Cerner. The $28.3 billion Cerner acquisition is one of their largest and most complex ever. Integrating Cerner's technology onto OCI, aligning its business processes, and realizing the projected cost and revenue synergies is a substantial multi-year challenge. Failure here could result in significant goodwill impairments on their balance sheet and a major strategic setback in the critical healthcare vertical they're trying to dominate.
A lot riding on making Cerner work smoothly on OCI.
A tremendous amount. The success of this integration is paramount for their long-term health vertical ambitions.
And finally, regulatory and geopolitical risks.
Finally, we have regulatory and geopolitical risks. Operating globally means Oracle is subject to an evolving and complex web of regulations. Stringent data privacy laws like GDPR can impose significant compliance costs and carry the risk of large fines for violations. As a major technology player, they also face the potential for increased antitrust scrutiny in their key markets, which could limit their strategic options or force divestitures.
Big tech scrutiny is always looming.
Always. And broader geopolitical tensions could disrupt Oracle's supply chains for critical hardware components or restrict its ability to sell products and services in key international markets, such as China.
So what you're highlighting is that while Oracle has developed very sophisticated mitigating strategies for many of these risks, like their differentiated multi-cloud approach and sovereign cloud solutions for regulatory compliance, the sheer scale and capital intensity of this transformation mean these risks are still very real, very present, and demand close, continuous monitoring from anyone watching Oracle.
Exactly. The ambition is huge, but so are the potential pitfalls.
Oracle's journey from an on-premise software giant to a cloud and AI challenger is truly one of the most significant transformations in tech history. It creates a compelling, highly complex narrative, and one that absolutely requires us to synthesize both the optimistic and skeptical views to understand its full potential.
Indeed. Let's break down the bull and bear cases that analysts are debating. The bull case for Oracle rests on the firm belief that their cloud transformation is not just succeeding, but accelerating dramatically. Proponents point to the hypergrowth in OCI revenue, which is their fastest growing segment, and the massive, undeniable $138 billion RPO backlog as irrefutable evidence of strong, contracted customer demand for their cloud services.
The bulls love that RPO number.
They absolutely do. They believe Oracle's differentiated technology, particularly its high-performance AI infrastructure and its unique autonomous database, combined with its distinct multi-cloud and distributed cloud strategies, are creating a sustainable competitive advantage in the enterprise segment that even the bigger hyperscalers will struggle to replicate for specialized workloads. In this view, Oracle successfully leverages its powerful database moat to establish itself as a top-tier hyperscaler. Cerner makes them a dominant force in healthcare IT, and the market ultimately re-rates the stock to a much higher cloud-like valuation, reflecting this new, higher growth recurring revenue profile.
So, the bull case is they pull it off, become a true hyperscaler, and the stock reflects that.
That's the essence of it.
Yep, what about the bears?
Conversely, the bear case emphasizes the immense risks and competitive pressures Oracle faces, and paints a more cautious picture. Skeptics argue that the massive capital expenditure required to truly compete with AWS and Azure will permanently depress margins and free cash flow without guaranteed returns, making the investments potentially value destructive.
Spending billions without a clear payoff, potentially.
That's the fear. They highlight the risk that the legacy on-premise business might decline faster than the cloud business can grow profitably, eroding their core and profitable base. Furthermore, they worry that the Cerner integration will prove more difficult and less synergistic than anticipated, creating a prolonged drag. In this scenario, intense price competition from larger rivals erodes OCI's growth potential and margin, leaving Oracle with high-cost infrastructure, a diminished legacy business, and ultimately leading to a derating of its valuation.
So the bear case is the costs are too high, competition too fierce, execution too risky, and the legacy business fades too fast.
That sums it up well. It's a high-stakes, all-or-nothing bet in their view.
Given all we've discussed, let's tackle some core questions that you, the learner, might be asking. First, how sustainable is Oracle's formidable database franchise in a multi-cloud world where companies are increasingly using different cloud providers and exploring alternatives? Is that crown slipping?
What's truly fascinating here is that the database franchise actually appears more sustainable, surprisingly, due to their incredibly pragmatic, strategic pivot to database at Azure, AWS, Google Cloud.
That multi-cloud database strategy we talked about. Exactly. By making their best-in-class database technology easily accessible and highly performant directly within competitor clouds, Oracle is pragmatically neutralizing the threat of customers migrating to those clouds' native database alternatives due to latency or egress cost concerns. They're protecting their most profitable business segment by meeting customers precisely where their applications already reside, eliminating those traditional barriers. It's a brilliant defensive move that has turned into an offensive growth opportunity.
Okay, so the database might actually be safer now. Interesting. What's the realistic timeline and financial impact of this cloud transformation? Is it something that's already happened? Are we still in the thick of it? Or is the biggest impact yet to come?
The transformation is well advanced, with cloud revenue now representing over 40% of Oracle's total revenue, so it's clearly moved past the early stages.
So nearly half their revenue is cloud now. Getting close. However, the near-term financial impact, particularly for fiscal years 2024 through 2026, is characterized by suppressed free cash flow and continued gross margin pressure due to this peak data center investment cycle. Oracle is guiding for the expected inflection point for significant overall revenue growth acceleration to occur in fiscal 2026, as that new capacity comes online and starts generating revenue at scale.
So FY26 is the key year to watch for acceleration.
According to management guidance, yes. If successful, the long-term impact will be a business model completely dominated by predictable, high-margin recurring cloud revenue, fundamentally reshaping their financial profile.
How does Oracle's integrated approach, that silicon-to-application stack, truly compare to companies that choose best-of-breed solutions, picking the top tool for each specific function from different vendors? What's the real-world advantage or disadvantage?
For large enterprises already deeply invested in Oracle's expansive ecosystem, particularly its foundational database and extensive ERP systems, the integrated stack offers compelling advantages. This includes superior performance due to deep optimization, enhanced security from a unified architecture, and potentially a lower total cost of ownership because you're dealing with a single vendor and highly optimized integrated systems.
Simpler for existing Oracle shops.
Generally, yes. The seamless flow of data between back-office ERP and front-office CRM is a significant operational benefit for these large, complex organizations seeking a unified view. However, For new cloud-native companies without those legacy Oracle investments,
Hmm.
the best-of-breed approach using specialized SaaS vendors on a hyperscale public cloud may still remain more attractive due to a perceived feature superiority in specific niches and greater overall flexibility.
So it depends on the customer.
It truly depends on the customer's starting point and specific business needs.
So for you, the learner, who wants to track Oracle's progress and understand if this multi-billion-dollar gamble is truly paying off, what are the key metrics you should be monitoring in their earnings reports? What are the essential signals?
Absolutely crucial are four things. First, watch the OCI revenue growth rate. This is the primary indicator of their success as a hyperscaler. It must consistently stay at or above the guided 50-70% range to validate their aggressive investment thesis.
OCI growth. Got it.
Second, keep a close eye on RPO growth and its conversion. The growth of that massive $138 billion backlog is the best leading indicator of future revenue, but also critically, watch the rate at which RPO is actually converted into recognized revenue, as that signals effective execution on signed contracts.
RPO growth and conversion rate. Okay.
Third, focus intensely on cloud gross margins. As new data centers are built and filled, look for clear evidence of stabilizing and then improving IaaS gross margins as economies of scale are achieved. This indicates if their cloud business is becoming profitably efficient.
Cloud gross margins. Need to see improvement there.
Exactly. And fourth, monitor operating cash flow. A return to strong positive operating cash flow growth after this peak capital expenditure cycle will be critical to demonstrate the long-term financial viability and profitability of this capital-intensive strategy.
Operating cash flow. Makes sense. So OCI growth, RPO, cloud margins, and cash flow.
Those are the big four to watch.
Oh.
And how does the current valuation reflect this? Oracle's current valuation reflects a market that is beginning to believe in the cloud transformation story, acknowledging the potential, but is still very much weighing the significant execution risks involved. The stock's PE multiple has expanded well beyond its historical average, clearly indicating that the flat growth legacy software narrative is no longer dominant in the market's mind.
The market sees the change.
It does. However, it still trades at a discount to established, pure-play cloud leaders like Microsoft. This suggests the market is currently applying a blended valuation pricing and substantial future growth from OCI and AI, but also applying a discount for the inherent competitive and financial risks in Oracle's capital-intensive strategy. The ultimate trajectory of the stock will truly be determined by whether the bull or bear case prevails in the coming years, hinging on their ability to execute.
Oracle's high-stakes transformation is truly a story of audacious reinvention, battling against established giants while leveraging its own deep, powerful foundations. It's a complex picture of ambitious growth and significant inherent risk.
The ultimate trajectory of Oracle will be determined by whether their bold gamble on cloud infrastructure and AI pays off, and whether they can consistently execute on their massive global build-out and convert that impressive backlog into sustained profitable growth. It's a testament to long-term vision meeting immense operational challenge.
So, for you, the learner, the question to mull over is this. Will Oracle's all-in gamble on cloud and AI ultimately redefine its identity as a true hyperscaler and AI powerhouse, forever shedding its legacy label? Or will it remain a testament to the enduring power of its database roots, even as it continues to reach valiantly for the clouds? Something to think about as you continue to dive deep